Hello again. In this video we will cover the FRTs that are indicated here, which stands for Flexible Reversionary Trust. Now, this is a type of trust that the vast majority of people have never heard of, but it has some very interesting methodologies of giving clients very flexible planning for their inheritance tax. So I'll point out here that flexible reversionary trusts are not in and of themselves regulated advice. However, in the planning that most of our clients do, these trusts are set up as part of regulated advice, and therefore you would need to be referred to our regulated partners in order to receive specific advice as to whether these were correct for you or not. But it pays to have an understanding in general planning principles of a flexible reversionary trust and what it does for people and how it works. So inevitably, it's a discretionary trust, as most of our other trusts are, except for the IHT. It's done on a single settler basis, so most of the time both clients in a married couple would have one each, because again it gives more flexibility. And the major benefit of this particular type of trust, and why it's the crux of this inheritance tax planning, is that you can make a significant gift into this trust of, let's say, the maximum possible £325,000 each. So that would be £650,000 into two trusts. Yeah, the normal 7-year rules apply, and provided we hadn't made any other gifts into trusts in the previous 7 years, that would be fine, and in most cases that's what would happen. And for nearly all clients this is a recommendation, because what it does is that it enables you to get capital back out of the trust. So in most discretionary trusts, you give the asset into the trust and that's it. You, the settler, can't get the money back out again. But hence the word reversionary. What this particular trust allows people to do is to have their capital revert back to them, be it at around 15% a year. So you can't get all of the capital back out again in one go, but if you can get around about 15% per year and you put 325,000 in, that's obviously quite a large sum of money. And if two people are doing that level and above, which is what it is in most clients, so most of our clients are probably putting in at least 100,000 each into one of these, and for many it's the maximum 325,000 each, because it fits so well with the planning. Because effectively it means that you've gifted a large amount of money into trust. It'll be outside of your estate, but every year the trustees ask you if you want your capital revert back to you. And if you don't want it to revert back to you, which isn't the case in most people's instance, then effectively it stays in the trust, and after 7 years the whole amount is outside of the estate. Now, if you were to take assets out of the trust and there was growth on those assets, then there would be capital gains tax or income tax to pay on those assets on the growth element, as would be normal in any event. So the main point to understand here is that it's a crux of the planning, that even if you're a client that prefers to hold mainly property, the problem is with property is that it's illiquid and you can't sell it immediately. Generally it takes several months, sometimes up to a year, to sell a property, whereas within these trusts every year you can get the money out and know when it's coming out and know which day it's coming out effectively. And if you choose at some point to you give up, let's say in most cases you wouldn't touch it for the first few years, because if we knew you were going to need the money within the first few years, we wouldn't put it all into trust because we felt you were using it. Right now, if in, let's say, year 5 you pull some money out and you don't want to pull out the full 15%, you don't have to. You can pull out any amount up to that level. And let's say you know that in year 6 your son or daughter's getting married and you're going to need more than 15%. Well, you would know that more than a year in advance usually, and you would therefore stack 1 year's 15% on top of another, and in the following year take 30. Yeah. What isn't possible is to stack every part on top of every other part and take it all out in one go, because that would be abusing the plan and make it liable to be refused by HMRC. But for most clients, this is great because it means they can hold a small amount in cash, because if every year you've got access to a large amount of money, let's say it's 325,000 times 15%, that's 4,000. That's 48,000 pounds a year you can get back, and if there's 2 plans, that's 96,000 plus you can get back. So those are flexible reversionary trusts, very, very useful for inheritance tax planning and pretty much default planning for nearly all clients in this arena, because it makes sense. But once again, the specific plan that we would recommend to you is regulated, and you would need to be referred to our regulated partners for this specific advice as to which company to use and how to set it up and all of that. But in principle, the purpose of this video is to explain it generically. It's not telling you to do it, because that's regulated advice. It's generically explaining that it makes sense for most people to have access to money on a regular basis and still have it outside of their estate if they don't need it. So hopefully that makes sense, and that's flexible reversionary trusts.